In 2024, the British pound outperformed both the US dollar and the euro, not because the UK was growing faster, but because the others were collapsing slower. The illusion of strength. A currency doesn't rise in isolation. It floats because something else is sinking. And right now, the pound is floating above two titans who are starting to wobble. The Federal Reserve is being pressured to pivot. The ECB is trapped between recession and fragmentation. Meanwhile, the Bank of England holds still, same rate, same message, and suddenly markets call the pound resilient. But zoom out, and the picture gets colder. The UK economy isn't booming, inflation still lingers, growth is flat, productivity has stalled since 2008, yet the currency is climbing. Why? Because in the modern monetary system, currencies aren't priced on strength, they're priced on perception, confidence, interest rate differentials, carry trades, flows, not fundamentals. The pound didn't win a race. It stayed in place while the others took a step back. This isn't new. The same illusion played out in 2015 when the Swiss franc spiked overnight just because the central bank let go, or in 1997 when the Thai baht collapsed and every other Asian currency followed. It's not about winning, it's about blinking last, and that's the game we're in. The pound isn't stronger, it's just the least weak. But to understand why, we have to ask, who's really writing the rules of this game? And who's losing control? Between late 2023 and mid-2025, the British pound quietly climbed from 120 to 130 against the US dollar. Not with fireworks, not with headlines, just a steady, stubborn rise, while other currencies slipped. At the same time, the euro lost ground. EUR to GBP fell, signaling a currency block under pressure. But while the pound strengthened, UK equities didn't rally. FTSE 100 remained muted. Bond yields held steady. Corporate earnings barely moved. This wasn't a recovery story. It was something else, a currency rising without the economy rising with it. That disconnect is where the real story begins, because currencies don't just measure national performance, they measure relative expectations, perceived safety, strategic positioning. In 2024, the UK economy was stagnant, inflation moderated, but growth didn't return. Brexit aftershocks lingered, yet the pound climbed anyway. Why? Because the others, namely the dollar and the euro, were slipping faster. The Federal Reserve hinted at rate cuts as early as late 2024. Political pressure and recession fears pushed them to soften. The ECB, meanwhile, was cornered by weak growth in Germany, rising debt in Italy, and fragmentation risk across the bloc. Markets started rotating. Investors didn't chase the pound out of optimism. They parked in it out of caution. Currency traders began positioning for interest rate differentials. Carry trades favored GBP over USD and EUR. Every uptick was a vote, not for the UK's strength, but for the other's fragility. And that's the hook. The pound's rise isn't a comeback. It's a commentary, a signal that in a system built on expectations, the winner is often the one who decays slowest. In a marathon where everyone is limping, the last one to stumble looks like they're sprinting. That's what's happening now. The pound is not being lifted by its own muscles. It's being buoyed by the weight of others collapsing, and that illusion can be powerful. Media headlines call it a comeback. Analysts debate whether London's financial center is regaining global appeal. But the numbers say otherwise. Investment isn't flooding in. Trade deficits persist. Wages remain flat. This is not a renaissance. It's a recalibration, a correction of perception. And beneath it all is a single question few dare to ask. If the pound isn't truly strong, what is everyone else afraid of? Because in the end, strength in currency markets is not absolute. It's always relative. It's never about who's healthy. It's about who's sick, less visibly. So what's fueling this confidence? The answer lies in interest rates, the modern weapon of financial warfare. The pound didn't rise on optimism. It rose on arithmetic. At the start of 2025, the Bank of England held its benchmark interest rate at 5.25%, not because the UK economy was booming, but because inflation hadn't fallen fast enough and political pressure to cut was still weak. Meanwhile, the Federal Reserve faced a different battlefield, an election year, slowing job growth, a manufacturing recession quietly creeping across the Midwest. By mid-2024, market pricing showed strong expectations that the Fed would pivot, cut rates, stimulate, ease. The same fear echoed across Europe. Germany, the Eurozone's engine, was sputtering. GDP growth for 2024 was just 0.3%. Italy's debt ratio crossed 140%. Spain remained politically unstable. The European Central Bank, faced with fragmentation risk and structural weakness, had little room to tighten. So, while the BOE stood still, the others blinked. And in currency markets, standing still can look like sprinting. Why? Because interest rates aren't just economic signals, they're magnets. Money flows where it's treated best. And in 2024, that meant Britain. Global investors began repositioning. Traders unwound dollar and euro long positions. They borrowed in low-yielding currencies, USD, EUR, and bought into assets denominated in GBP. This is the essence of carry trade, not a bet on strength, a bet on spread. The larger the gap, the more attractive the trade. Even if the underlying economy is weak, even if fundamentals are fragile, as long as the yield holds, the flow continues. That's how currencies move, not because of factories reopening or exports booming, but because rate differentials create momentum. A shadow economy of speculation wrapped around central bank policy. In that world, perception becomes reality. The BOE didn't promise strength, it merely refused to panic, and that was enough to paint the pound as disciplined, controlled, while the Fed and ECB looked uncertain. This is the part of currency mechanics rarely shown in headlines. It's not about patriotism, innovation, or GDP. It's about math. Cold, boring math. A central bank that delays cutting rates, even in stagnation, sends a louder message than one that cuts in panic. And that message reshapes global capital flows. But there's a twist. This game isn't static. As soon as expectations change, flows reverse. If the BOE shows weakness, if inflation falls faster than expected, or political pressure mounts, the pound's yield advantage disappears. And the same investors who bought the pound for its spread will sell it just as fast. Because they were never loyal to Britain, they were loyal to the math. That's the fragile truth behind strong currencies. They're not powered by pride, they're fueled by spread. Currencies don't move forward on their own, they're dragged forward by the shadows of interest rates ahead. But rates alone don't decide trust. Sentiment does. And sentiment is fragile, especially in Europe. The euro didn't fall because of a single crisis. It fell because of a silent accumulation of fragility. In 2024, Italy's debt-to-GDP ratio approached 140%. Germany, long considered the backbone of Europe, slipped into a technical recession, 2 consecutive quarters of economic contraction. And while these numbers hit headlines, what didn't was the structural paralysis inside the European Central Bank. The ECB couldn't raise rates aggressively, even as inflation lingered. Why? Because tightening too fast could push Italy toward default and fracture the Eurozone. This is the price of union without unity. Fiscal rules exist, but enforcement is political. One nation's stimulus becomes another's inflation. One country's weakness becomes everyone's liability. Investors saw it, and they moved. Capital doesn't wait for consensus. It flees instability. Throughout 2024, Eurozone bond yields diverged, credit spreads widened, and while the ECB spoke of coordination, markets saw hesitation. Confidence eroded. Meanwhile, across the Channel, Britain, post-Brexit, wasn't thriving. But it was free. No longer bound by EU fiscal treaties, the UK could adjust its monetary stance without needing continental approval. The BOE didn't need to consider Italian debt or German deflation when setting rates. It only had to look inward, and in times of uncertainty, simplicity becomes strength. Investors reallocated, not because the UK offered growth, but because it offered clarity. The pound, once seen as a victim of isolation, became a relative safe haven, not from strength, but from being less entangled. This is the paradox of modern monetary systems. Independence, once considered risk, became insurance. Brexit didn't make Britain richer, but in the eyes of currency traders, it made Britain more predictable. In contrast, the euro became a collective bet on compromise, at a time when compromise looked expensive. That's why the GBP outperformed the EUR. Not because Britain won, but because Europe faltered. The pound rose not from triumph, but from context. And that's the hidden truth behind currency strength. Sometimes survival in a broken game is mistaken for dominance. It's a lesson in perception, one that echoes through every crisis. In 1992, Britain crashed out of the European exchange rate mechanism, humiliated by markets. 30 years later, it was Europe's turn to be punished by the same forces. Two ships tied together by trade, history, and sentiment, but one is leaking beneath the waterline, the other just staying afloat. Still, strength can be an illusion, especially when it's priced into the past. Let's talk about how currency value misleads you. £1 equals $1.25. But that doesn't mean the British economy is stronger than America's. It simply means we're reading the scoreboard wrong. Nominal exchange rates are a distraction, numbers printed on the surface, masking what's underneath. The pound has historically traded above parity with the dollar, not because it's more powerful, but because of inertia. When the dollar was created in 1792, it was pegged far below the pound, reflecting Britain's dominance at the time. That pricing structure persisted, even after the UK lost its empire, even after the dollar became the world's reserve currency. Legacies linger in currency math. But in reality, today's pound isn't stronger. It just looks more expensive, like a stock that hasn't split. The real story lies in the rear, the real effective exchange rate. This adjusts for inflation, trade weights, and purchasing power. And when you look through that lens, the British pound is far less impressive. In real terms, the dollar has outperformed for most of the past 2 decades, not because it's priced higher, but because it holds value across global transactions. You don't measure strength by face value. You measure it by trust, usage, and durability. History offers proof. In 1985, the Plaza Accord deliberately weakened the dollar to correct trade imbalances. The pound rose, not because Britain was thriving, but because America chose to devalue. This wasn't strength, it was context. Other currencies once looked expensive, too. The French franc, the Italian lira, both traded at high face values until they were retired, converted into the euro at artificially pegged rates. High nominal value didn't save them, because numbers don't protect you from fundamentals. 100 Zimbabwean dollars won't buy you lunch, even if the bill says 100. Price tags lie, especially in foreign exchange. The illusion of strength seduces investors into overconfidence, into thinking 1.25 means dominance rather than drift. But central banks don't care about vanity metrics. They care about flow, inflation, interest differentials. That's where the game is played. The pound's nominal pricing is legacy, not leverage, and mistaking the former for the latter is a dangerous illusion. If you're holding GBP thinking it's inherently stronger, you're betting on nostalgia, not mechanics. In modern currency markets, psychological anchors are weapons. They make the mediocre look majestic, and the fragile look fixed. But when shocks hit, when inflation spikes or capital flees, those illusions don't hold. Only fundamentals survive. So the next time you hear that the pound is expensive, ask, expensive compared to what? Nominal prices are set by history. Real value is set by function. And right now, function is everything. Because in a world of artificial confidence, face value is the last thing you should trust. So if it's not oil, not politics, not even the price tag, then what really powers a currency? People think currencies are powered by strength, military, technology, resources, reputation. But markets don't pay for pride. They follow pressure. Take oil. The UK exports around 1 million barrels per day. Sounds impressive until you compare it to Saudi Arabia's 7 million or the US at nearly 12. Britain is not an energy superpower. Its oil output doesn't move global flows, nor does it underpin the pound. It's just noise. How about defense? The UK is one of NATO's top spenders, but so is the US, and the dollar still lost 12% of its value between 2020 and 2022. Military might doesn't immunize your currency. Weapons win wars, not inflation battles. What about AI and tech? The UK is building a name in quantum computing, biotech, and data regulation. But Japan did that in the 90s. Germany, too. Both saw their currencies fall while their industries rose. Innovation doesn't always equal appreciation, because capital doesn't chase code, it chases confidence. Then there's soft power, royal families, BBC documentaries, Oxford, Wimbledon, cultural exports that shape global perception. But sentiment isn't settlement. No investor buys pounds because of Shakespeare. National branding builds slow influence, not short-term flows. The truth is colder. Currencies move on 3 things: real interest differentials, capital flow momentum, and perceived policy credibility. That's it. Everything else, oil, guns, AI, soft power, is theater. stage props in a game run by central banks, hedge funds, and bond markets. The pound rose not because Britain wowed the world, but because the alternatives looked shakier. Money flowed where policy seemed firmer, not flashier. And that's the hard lesson. What you see on the surface is rarely the engine underneath. Thinking that oil exports will lift a currency is like painting a car and expecting it to run faster. Power comes from the engine, monetary mechanics, not marketing. Investors don't reward symbolism. They reward spreads. They reward predictability. And they punish weakness, even if it's wrapped in prestige. This is why the lira collapsed despite centuries of Roman legacy, why the franc faded despite French culture, why currencies die even as their countries remain iconic. Because valuation doesn't care about nostalgia, it cares about trust, and trust is mathematical, not emotional. In 2025, the pound didn't gain because of empire, oil, or innovation. It gained because the Bank of England held steady, while others blinked, because the UK looked slightly less desperate than its peers. That's not glory, that's relativity. When markets panic, they don't pick the strongest, they pick the least weak. And in currency wars, survival isn't won with style. It's won with silence, patience, and credible policy. So forget the headlines about British tech, oil deals, or royal weddings. None of it moves the pound. Only money does. And money has no loyalty, no memory, no flag. And when all noise fades, only one thing drives currencies: trust. But trust in what? The British pound didn't win because Britain did. It won because the others misstepped. The Fed pivoted under political pressure. The ECB got trapped by weak growth and fragile debt. And while they blinked, the Bank of England stood still. That pause was interpreted as strength, but it wasn't power, it was posture. Because currencies aren't medals for national achievement. They're reflections of collective expectation. And expectations are fickle, fragile, and easily manipulated. The pound wasn't strong, it was simply less uncertain. And in a world where money runs on trust, less uncertain is all it takes to lead. For now. Tomorrow it might be the yen, or the yuan, or Bitcoin, or something no one sees coming, until it's too late. Because this isn't about Britain. This is about the machinery of money, a machinery that rewards not those who shine, but those who survive. In 2008, it was the dollar. In 2023, it was gold. In 2025, the pound. But what happens when even the dollar no longer feels safe? Where does the trust go then? That's the only currency that truly matters. History doesn't reward the strongest, it rewards the last to fall.